guys, it's Chad Larson with MLD Wealth Management of Canaccord Genuity. I'm joined here today again by Tom Caulfield of Fidelity Investments. We've spoken many times throughout the past few weeks, and today we're here to talk a little bit about fixed income. There's many others that manage fixed income, but understandably, Fidelity being the world's largest asset manager and managing over $1 trillion in fixed income assets matters here. And so I'm pleasure to be joined by Tom, and we're going to get right into it and really talk about why fixed income. I always kind of call it the vegetables of the investment world. Not everyone loves them, but it's important and it's part of a balanced meal, and they're good for you. We've talked a lot about how fixed income acts like a goaltender or defense in periods of volatility, and we saw that through the market crash that we just experienced, and now more so as we look to the recovery, we look to things that the Fed has done, hasn't done, how the economy reopens and gets back to a normal sense of where we have strong economic activity. We're still recommending and we're still seeing strong opportunity set in fixed income and why. But first, why we really got there. When the VIX spiked in March, the only really place was to hide was in duration. We had a large tilt to long duration bonds, which seemed kind of crazy, kind of late January, as interest rates were already low and the economy was roaring and everyone was shouting at the Fed to raise interest rates and cool things down a little bit. We were hit with kind of a 1-2 punch of Corona compounded with a complete global shutdown of the economy. So we saw, the yield curve inverting and all of these things that have happened. They're hard to understand, and so we'll try to talk and use some analogies and try to keep this as fun as we can. So with accommodative easing that's happening from the Bank of Canada and the Fed, we've talked about the absolute veritable bazooka that the Fed has brought to the party, both fiscal and monetary policy. And now we've got yields close to zero, government bonds offering very little return potential. And while duration may not be a source of return going forward, it also shouldn't be our enemy. So historically, as we move out of a high vol environment, which is represented by the VIX or volatility index or fear index, corporate bonds can offer significant capital gains exposure, albeit that entry window can be short. So I'm going to pass it over to Tom a little bit to just talk about the topic and what we're seeing right now as an opportunity set in fixed income. And I hope you guys enjoy it. Tom, thanks again for being here.
Thank you so much, Chad. And once again, thank you to your team for your leadership, for putting these presentations together. I think your clients are going to really, really enjoy these in the days to come. So things to consider for fixed income that you alluded to is really part of the overall portfolio construction, really adds that stability when we see those downdrafts in the market. And some of the areas we want to consider is diversification, duration, how long we extend the bonds out, and then being aware of yield traps. So many global mandates have significant allocation to Canada. We would certainly consider diversifying from that to gain access to the breadth and depth of global bond markets. With duration, while duration likely won't offer the same protection going forward, we don't believe it's something to fear. Consider where the duration is coming from. Investment grade bonds are a great way to lower duration relative to government bonds, but manage credit risk of the portfolio as well. Oftentimes, having a very low duration can either mean short term, which has little room for returns currently, or taking on significantly higher credit risk. That all being said, a well-balanced portfolio as well as a well-balanced fixed income portfolio is key going forward. We're seeing about 10,000 people retiring every day, and we see tremendous appetite for fixed income going forward.
To talk a little bit about value traps, and maybe I'll digress or dive around. As we were preparing for the Zoom call, I was actively reducing exposure to some sectors, ahead of earnings. Not to give secret sauce, but these value traps are obviously compounded when we have analysts' expectations and the markets trade on different variables, whether function EV to sales, revenue, EBITDA. Again, we've made an industry of jargon, but it's that median representation of where we see value. The the most basic value trap is to understand is that before we can even rediscover what an expectation is, a forward earnings expectation, which right now in the midst of COVID, no one knows what earnings are going to be. I think, but it's a general consensus they're going to be bad. How bad, how less bad. But as stocks start to screen cheaply as a function of their trading prices over their expected earnings, so we could start to see significant surprise for that. So more than anything, are you starting to see institutional flows as we're looking to maybe transition out of some equity exposures post rebound? I mentioned to a client the other day, we were taking profits last Friday. It seemed weird. Profits is a relative term to where positioning, but relative to movement in the market, there's been strong profits off of the bottom. Is this a place to add not only diversification, but to increase breadth and caliber of our capital structure position?
I think that's a tremendous opportunity set. We saw a minus 35 in a staggeringly fast amount of time, 24 days. We've seen a retracement of the market in about 32 days of 60%. And I just feel that institutional clients, retail clients are going to have tremendous, tremendous appetite for the wide array of fixed income. I mean, the fixed income, the debt security market is larger than the stock market. And there's a tremendous amount of global opportunity around the world. And it really, I think, it just comes down to the Feds. The old adage of don't fight the Feds. To your point, the double bazooka, they have tremendous amount of ammunition to still continue to stimulate not only the debt security market, but also the stock market. And many folks on the institutional side are quite frankly buying a tremendous amount of our institutional products because they were unhappy with what they experienced in this downdraft. And we've got some insular type mandates that we're really going to provide that goalie experience for clients. And we really think that on the retail side, folks are going to say, Chad and your team, you've done a wonderful, wonderful job for us. And we may want to look at more fixed income. We just might not want to experience 10% volatility every 8 months.
Yeah. And I think, we'll probably, this was really poignant. Historically, we do want to increase exposure to corporate bonds in a rising default environment, looking through and, being sensitive to what we, can say and can't say on a call from making predictions. But I don't think anyone is out of line in making the assumption that corporate earnings are going to struggle. And you're looking at some of those bellwethers of the Canadian economy to be one in defaults. People at home this long, they struggle to make ends meet. They struggle to pay their bills. And it's not just mortgages. It's cell phone bills. It's cable bills. It's every type of thing that we have when you have a reduced revenue opportunity set, whether you're a business or a consumer, is going to strain things. And our equity values are only, it's something I always kind of struggle with, call it at a almost ethereal level, is what is an equity? Well, we know it's a percentage ownership in of an underlying business. I can sit there and say, I own part of Amazon. Me and Jeff Bezos are buddies, because I own 5 shares. But jokingly, what that will look like is as an equity trades as a multiple of expected results. And as we see results in the short term, I don't think the world's over, because all of this is for naught, and we should have just enjoyed our last few weeks or months of modern living as we go into some archaic scenario, which I don't believe is the case. But we have to consensus and be able to react to scenarios whereby we're going to see drastically impaired corporate earnings. Will dividends be called into question? Will dividends be paired? Will there be a flight and rotational shareholder rotation through that? will companies need to raise equity, at prices they don't want to raise equity at and dilute their equity base? We have strong convictions right now. Fixed income has always played a major role in I believe a prudent style of wealth management that is geared towards meeting a client's long-term objectives over market cycles. So it's tough because people want to get back to this high water mark and obviously look to equities to provide the most leverage. But with higher certainty, I'd rather make a dollar than with less certainty and more volatility make two. Sometimes you have to call things for what they are, and that probability of an expected return should be something that should be very much taken into account. There's always a way to make more money, but the risk reward ratio between risk and reward, I try to tell people they're not linear. It's exponential. I don't know what the exact ratio is, but it is exponential. For every additional unit of return that we pursue, there's more than one unit of risk. So let's leave it there. This is nice and tight and short. Todd, I really appreciate you guys taking the time and the stewardship and the guidance that you guys have been able to support MLD and our clients through this. So I look forward to the next one, and we'll chat soon.
Thank you so much, Chad. My
Thanks.
pleasure.